Hello, welcome to our channel. It's Nedu here, your forex coach. In today's video, I'm going to be teaching you on how to locate high probability trading opportunities using some technical analysis in combination with the Fibonacci retracement tool in searching out these huge trading opportunities that you can make lots of money in the market. Alright, if you're coming for the first time, we say very welcome to you, and if you've been here, welcome back. And if you like this video, I'd like you to hit that like button, share, and then subscribe to our channel so we can make this video available to as many people as possible. Alright, welcome back. Let's go right into the strategy. Today, I'm going to be showing you how to use the stochastic indicator and the exponential moving average 21-day period and also the 50-day period. Of course, I'm just assuming you know how to set this up. The 21-day period exponential moving average, you set it to close, and then the 50-day period, you can choose any color, but for the sake of this training, the color for the 21-day exponential moving average is orange, while the sky blue color is the 50-day moving average. And of course, you also set your stochastic indicator at default setting. Just select it at default setting. So we're going to use these two technical indicators in combination with the Fibonacci retracement tool and locate very high probability trading opportunities. Now, you can trade this, you can find these opportunities in any time frame. Any time frame, whether it's daily time frame, 4-hour, or the hourly time frame, okay? And you can choose any pair of your choice. But one of the basic conditions is that you use this in trading only trending markets. In other words, you either trade the market when it is trending upwards or trade it when it is trending downwards. And of course, I assume also that you know that the trend is your friend. You've heard that, you may have heard that statement over and over again. And the reason is that when you are trading trending markets, trading in the direction of the underlying trend is easier to make profit and also to locate trading opportunities than when you are trading against the trend. That's counter trend. All right. So in this particular currency pair, that's AUD Canadian dollar on 4-hour time frame, I've already set my two moving averages. Orange color is the 21-day moving average, while the sky blue color is the 50-day moving average. All right, so what we are looking at here for the stochastic indicator, you set it at of course it's calibrated from 0 to 100, but you select the levels 80 and 20, so that from level 80, that's this dotted line, to 100, this denotes for you when the market has gone into the overbought position region, and then below 20, that's between 0 and 20, shows you that the market, it indicates when the market has gone into the oversold zone. And of course, the assumption for that is that when the market has been overbought, it will begin to sell, price will drop. And when it is oversold, it will begin to buy. It gets the interest of the buyers when the stochastic indicator falls below 20. So even if it's 10, 19, 18, you know, buyers will begin to get ready to take over the markets. All right. And in a trending market, you know, market will make these swings, you know, if it's going upward, swings high, swing low, up, down, just like that. So where we're going to be interested in trading this uptrend, we'll be interested only can do a trend line like this to get all the lows, and this will be your support areas. All right, we'll be interested only in buying the market if it is trending. We're interested in only buying the market. Of course, we know the market is going to make series of swing highs and swing lows. So after a swing high, to make a swing low, a swing high, swing low, like that, until the trend is exhausted and market will reverse. But while the trend is still valid, and of course, to locate a trend, it's advised that you locate that trend in either 4-hour time frame, higher time frames, 4-hour time frame, daily time frame, or even the weekly time frame, wherever you choose to locate the trend. So you know the underlying trend at that time. You will be able to stick out what the market environment that you are trading. As a trader, it's important that you know which market environment that you are trading. So in this trade, we'll only be looking out for when the price has made a swing low. That's these areas. That's what we'll be looking out for, so we can buy. We are buying the lows. We are not going to sell when it has made a high. To be risky. But for just this strategy, you're only going to buy when the market is making, an uptrend. If it's an uptrend market environment. Okay, so let's look at this particular example. Okay, you can backtest this as oftentimes as you can, so you can develop some level of confidence on the strategy. And this is it. Here we can see this 4-hour time frame. From this point to this level, from here to here, the market entered into an uptrending environment from here to this point. You can agree with me, made a double top reversal pattern. You see, price hit this level. Let me pick one of the twos here. Okay, let me take this line to show these levels. Okay, right. So price moved to this resistance zone. It was, rejected. It moved back there, and this was it. It was at this point that it started making, entering into a different trading environment, and that is a downtrend. So we look at our moving averages. You see the first push downwards got to this point. Really don't, you don't need to bother how low it goes. Your interest is in getting to know when the price has moved into the reversal zone. From here, it made this, bearish impulse downwards, and now pulled into what we call the reversal zone, reversal region. All right, retracement area. So the retracement area is the space between the 21-day moving average and the 50-day moving average. All right, so when price enters between those two lines, the blue line and the orange line, that's what you are looking at for. When the price has made an impulse, of course, there will be a correction, there will be a retracement, and I want that retracement to enter into the reversal zone. Okay, so right here, the reversal zone, I'll take a vertical line. Let's put a vertical line there. Exactly. Okay, here price has entered between 50 and the 21 EMA, so it has entered that area. So that's one condition for this particular strategy. Price has moved into the retracement zone. All right, and at that point, same point, we'll check our stochastic indicator. Will check again, has it moved into the overbought zone? Exactly. Overbought zone is a region between 80 and 100. You can see at this point the stochastic is reading 87.94, so it's within that range. It has entered here, so we know that this condition has been fulfilled. First condition is that the market must be trending either upwards or downwards, and we are seeing that happening. There is a reversal here, a change in trend. Okay, that is one condition. The second condition states that the price would have retraced into the retracement zone. Right, it has moved into the retracement zone. That's the final level of retracement. So at this point, I'm going to use my Fibonacci retracement tool to find out what level of retracement it has gone. And I see very strong retracement. Prices retrace between 38.2, 50% and 61.8. These are strong areas of retracements that you know that the market has ended that pullback. So from here to this point, let's pick that to retracement to from here. You drag it to the low, from the high to the low, and you leave it. So where it is, where is it at this point? It is exactly at 50%. So we are already in the retracement zone based on Fibonacci retracement tool. All right, I say that again. The Fibonacci retracement tool, the major zones, most, historically, if you look at trends, prices retraces and bounces off at 38.2% or 50%, at most 61.8%. All right, and this condition also has been fulfilled. It has been fulfilled. I will take another tool. Okay, we've confirmed this. Okay, we check the stochastics is above the 80 handle, meaning that it has been overbought. So after overbought, the market will begin to sell. So at this point, this area will begin to look for an entry. So here, some of the entry strategies can now begin to look for is some candlesticks formations. Some candlesticks formation that will give you a reversal sign that will trigger your entry. Some of them, one of them is the engulfing pattern. You can use engulfing pattern like I'm seeing forming here. There is an engulfing pattern that formed here. I want to blow this. Let's make it bigger. Okay, it's good to make it bigger so it can be clearer. Fine, this is fantastic. You can see this bearish candle totally engulfing the last bullish candle in that final level of retracement. So this is your confirmation for entry. Immediately after this first bear candle, okay, there could be, most time there could be a retracement. You check the candle that is forming, there could be a retracement. You still be patient. You have seen this reversal sign. These are a bearish engulfing, which is telling you that markets will reverse from this point, and all these are confirmations. Okay, price has gotten to around the 61, between 50 and 61.8% retracement handle, and we're already in the overbought region based on stochastics. Okay, and also using the EMS, price is within that retracement zone as well. So this has confirmed my entry. So I'll be getting ready to enter. Usually I will have to wait for price to pull back also. I'm going to expect the market to push back. All right, maybe not more than 50% of the length of this candle. Sometimes it will not even happen. Like you are seeing here, there is just a pin bar. So immediately that pin bar finishes forming, this is your entry. So at the close of that pin bar is your entry. So let's use this line as our entry. Let's use this line to locate, to denote our entry. Yes, here, this is the entry price where that small pin bar closed. Okay, so here we'll take our entry here, and you go back to the high of this particular swing, high. The high, you take maybe about 5 pips above it, and this will be your stop loss. About 5 pips above it will be your stop loss. So let's put that will be your stop loss. Okay, 5 pips above it will be your stop loss. You see this here. 5 pips will be your stop loss, and I'm coming here to locate my entry at this point. So this to be my entry point. My entry point. All right, here. All right, so how am I going to locate my take profit? My take profit, it will be a function of the stop loss and then some structures that we're going to see in the market. I usually would take profits about 2 times or 3 times, sometimes 1.5 my risk. All right, so if this is the entry, I'm going to check how many pips that entry is, so look at this structure. This level is a level of support, so the price can get to this point and then bounce off. Of course, looking at this is about 2 times my stop loss, so this is a very viable trade. All right, it's a viable trade, and you can see the market moved very well and will hit your take profit here.